China just bought 225 tons of gold in a single year. Russia holds 2,335 tons worth $217 billion. Together, they're quietly accumulating thousands of tons while the dollar loses its grip on global finance. Do they know something we don't? On October 7, 2025, gold crossed $4,000 per ounce for the first time in history, hitting $4,058 the next day, a 52% surge in less than a year. But here's what most investors are missing. The last two times gold spiked like this, it crashed between 44% and 57% within 4 years. So the real question isn't whether gold reached $4,000. The question is whether this time is different, or whether we're about to witness another brutal correction that destroys portfolios. October 1st, 2025. Midnight. The United States government shuts down after Congress fails to pass a funding bill. Economic data releases halt. Federal workers get furloughed. Military personnel worry about their paychecks. Markets face complete uncertainty without basic economic indicators. Gold surges $400 in 18 weeks, the steepest climb since 1980 and 2011. But that's just the spark. The real explosives were already in place. Back in April, President Trump's Liberation Day rattled markets when he imposed a 10% baseline tariff on all countries and reciprocal tariffs up to 54% on 57 nations. Average U.S. tariff rates exploded from 2.5% to 27%, the highest in a century. Stock markets crashed, trade wars escalated. By September, the Fed cut rates to 4.00 to 4.25%, making gold more attractive. The dollar collapsed 10% year-to-date, the worst start since 1973. Dollar reserves dropped to 57.8% of global central bank holdings, down from over 70% in the 1990s. Ken Griffin from Citadel said it perfectly. We're seeing substantial asset inflation away from the dollar as people look for ways to de-dollarize their portfolios. Meanwhile, geopolitical chaos everywhere. Middle East conflicts, Russia-Ukraine war, US-China, trade war with combined tariffs hitting 145%. Political instability in France, Japan, Canada. Every crisis pushed more investors into gold as safe haven. But none of this explains what's really happening. Because beneath the surface, central banks are executing the largest gold accumulation in modern history. For 3 straight years, central banks bought over 1,000 tons of gold annually. That's 25 to 30% of total global mine production. This creates a structural floor under prices that didn't exist in 1980 or 2011. This is the game changer. China leads with surgical precision. They officially reported buying 225 tons in 2023, the biggest single-year increase since 1977. Another 44 tons in 2024. 11 consecutive months of buying through September 2025. Official holdings, 2,298 tons. But here's where it gets interesting. Industry experts believe China's real holdings are 5 times higher. Barrick Gold's CEO estimates China secretly holds between 5,000 and 5,065 tons. If true, China would be the world's second largest gold holder after the United States. And nobody knows for sure because 2/3 of central bank buying in 2024 was undisclosed. Russia accumulated 2,335 tons, representing 34% of its reserves. After the 2014 Crimea sanctions, Russia went all in on gold, buying 80% of domestic mine output during peak periods. That's $217 billion worth of insurance against Western financial pressure. India bought 73 tons in 2024, bringing holdings to 879 tons. They bought every single month through November. And here's the signal everyone missed. India repatriated gold from overseas storage back to domestic vaults. That's a sovereignty play. Poland bought 90 tons, targeting 20% gold reserves. Turkey added 75 tons. Czech Republic bought 20 tons, aiming for 100 by 2028. Azerbaijan, 25 tons. The list goes on. Quarter by quarter, the numbers are stunning. Q1 2024 set records with 290 tons, highest Q1 ever. Q2 added 183 tons. Q3 brought 186 tons. Q4 surged with 333 tons. In 2025, Q2 alone recorded 166 tons, which is 41% above historical averages. The three-year total, 3,164 tons. Poland's central bank governor put it bluntly. Gold will retain its value even when someone cuts off power to the global financial system, destroying traditional assets based on electronic records. The 2022 freezing of $300 billion in Russian reserves changed everything. A World Gold Council survey found 62% of respondents believe the dollar's reserve share will decline over 5 years. Between 2008 and 2021, BRICS nations increased their share of global gold reserves from 5% to 22%. Russia and China combined hold approximately 4,634 tons. With total BRICS holdings exceeding 6,000 tons, these nations now possess real monetary leverage. This isn't speculation. This is documented, systematic accumulation by the world's largest economies. And it's fundamentally changing the gold market. January 21st, 1980. Gold peaks at $850 per ounce. That record stood for 28 years. Adjusted for inflation, that equals roughly $3,590 today, which means gold has never actually beaten its 1980 peak in real terms, even now at $4,000. What drove the 1980 spike? Perfect storm. U.S. inflation hit 14.8% in March 1980, highest peacetime reading ever. The Iranian Revolution led to the November 1979 hostage crisis. 52 Americans held for 444 days. Soviet Union invaded Afghanistan in December 1979. Cold War tensions exploded. Oil crisis sent prices from $13 to $34 per barrel, with panic buying pushing it to $50. Gas lines across America. Energy panic. Gold started 1979 around $217 and closed at $512. That's 120% in 1 year. The climb to $850 reflected pure desperation as Americans faced inflation, energy crisis, international humiliation, and superpower confrontation simultaneously. Then Paul Volcker became Fed chairman. October 1979, he announced dramatic measures. Federal funds rate climbed to 20% by June 1981. Prime rate hit 21.5%, all-time records. This triggered the brutal 1981 to 1982 recession. Unemployment peaked at 10.8%, highest since the Great Depression. Gold crashed from $711 in September 1980 to $304 by June 1982. That's 57% in 21 months. It kept falling through the 80s and 90s as inflation died, the dollar strengthened, and geopolitical tensions eased. Gold bottomed at $252 in July 1999. The Financial Times published The Death of Gold in 1997. Central banks sold their reserves. Gold took 28 years to break $850 again. In inflation-adjusted terms, it never recovered. That's what happens when crisis fears prove overblown and monetary policy normalizes. September 5th, 2011. Gold peaks at $1,896, with intraday trading hitting $1,917. This was 50.6% above September 2010 levels. The rally was driven by the 2008 financial crisis and unprecedented money printing. When Lehman Brothers collapsed in September 2008, forced liquidation drove gold to $692 by October. But then the Fed unleashed QE1, $1.75 trillion at $100 billion per month. Rates dropped to zero. Gold recovered and climbed. QE2 added $600 billion from November 2010 to June 2011. During those 8 months, gold surged 50.6%. The 2011 peak happened during multiple crises. S&P downgraded U.S. debt for the first time ever. Eurozone debt crisis threatened Greece, Portugal, Spain, Italy. Stock markets tumbled. England faced its worst riots in 200 years. The crash was vicious. Gold fell to $1,598 by September 26th, 20% in 3 weeks. But the real carnage came in 2013 during the taper tantrum. When Fed Chair Bernanke hinted at ending QE on May 22, 2013, markets panicked. His June 19th confirmation triggered the worst sell-off. Gold plunged to $1,180 by June 28th, 25% decline in 1 quarter. Full year 2013 saw 30% drop. Gold bottomed at $1,045 on December 17, 2015, the exact day the Fed raised rates for the first time since the crisis. Peak to trough, 44.64% over 52 months. The decline resulted from Fed normalization, stronger dollar, rising real rates, improving economy, and inflation that never materialized despite massive money printing. Gold took 9 years to beat its 2011 peak, finally reaching $2,073 in August in 2020 during COVID. Both spikes, 1980 and 2011, followed the same pattern: crisis-driven rallies, investor euphoria, then crushing multi-year bear markets that destroyed wealth. Technical indicators scream danger. RSI over 80, well above the 70 overbought threshold. This is the 4th time in 2025 gold reached these levels. Gold's 18-week $400 gain matches the steepest climbs before the 1980 and 2011 tops. Gold-to-silver ratio hit 86 to 100, historically extreme. At the 1980 peak, it was 15 to 1. At 2011, roughly 30 to 1. History is clear. 100% of major gold spikes crashed. 1980, down 57% over 21 months. 2011, down 44.64% over 52 months. If 2025 follows this pattern, gold could drop to $2,214 or even $1,710 within 2 to 4 years. But critical differences exist. Central banks have been net buyers every year since 2010, accumulating over 7,800 tons in 15 years. They now hold 18% of global reserves versus much lower historical levels. They absorbed 25 to 30% of annual mine production in 2022 to 2024. This creates a structural flaw. The 2025 rally shows more consistency with 80 new all-time highs since early 2024 rather than one parabolic spike. Supply is lower than 2005 despite higher prices. Projections show an 800-ton production deficit by 2026. Most analysts project 20 to 30% correction to $3,000 to $3,200 as more likely than the 50% plus crashes of the past. However, if the Fed pivots to rate hikes, geopolitical tensions resolve, or central bank buying stops, deeper corrections remain possible. Bank of America warned on October 6th that gold faces uptrend exhaustion with potential consolidation or correction in Q4. Goldman Sachs leads the bulls with a $4,900 target by December 2026. They project 80 tons per month of central bank buying, 960 tons annually. Their research emphasizes that central bank purchases have altered the dynamics since 2022. Under extreme scenarios, they see $4,500 plus. JP Morgan targets $4,000 by mid-2026, calling gold one of the most optimal hedges for stagflation, recession, and policy risks facing markets. They project 900 tons of central bank demand in 2025. Their bull case sees $6,000 by 2029 if just 0.5% of foreign-held U.S. assets shifts to gold. UBS projects $4,200 coming months, recommending 5% portfolio allocation. TD Securities offers the most aggressive target at $4,400 by Q2 2026. On the bear side, Bank of America warned investors to approach cautiously, citing uptrend exhaustion after the 50% plus rally. Ray Dalio recommended on October 7th, something like 15% of your portfolio in gold. Gold is the one asset that does very well when the typical parts of your portfolio go down. Ken Griffin expressed concern. The development of gold as a safer asset than the dollar is really concerning. World Gold Council's survey found 95% of central banks expect global gold holdings to increase, with 43% planning to boost their own, highest since 2018. Consensus forecasts average $3,950 for 12 months, with bulls seeing $4,500 to $5,000 plus, and bears expecting consolidation at $3,200 to $3,500. Gold's breach of $4,000 represents a genuine shift in the monetary system. Central banks now hold 18% of reserves in gold, creating permanent demand absorbing 25 to 30% of mine production. BRICS nations control over 6,000 tons and continue accumulating. Gold's role as insurance against sanctions and currency debasement has been proven. Yet, technical indicators flash red. RSI over 80. Gold-silver ratio at century extremes. Steepest 18-week climb since the previous peaks. History says 100% of comparable spikes crashed 44 to 57%. The question is whether structural changes, permanent central bank buying, supply deficits, monetary competition, create a higher floor around $3,000 rather than catastrophic crashes. Both 1980 and 2011 peaked in September, followed by swift corrections and ultimate bottoms 21 to 52 months later. If history repeats, gold holders face a challenging 2026 to 2028. But if structural demand proves durable, if central banks keep absorbing supply, if geopolitical fragmentation intensifies, if dollar dominance keeps eroding, then $4,000 may be a platform, not a peak. Gold has never been more expensive in nominal terms, yet structural demand has never been stronger. Whether this time is different will define the next chapter of monetary history.